What is the one thing all investors want? The holy grail, if you will. It would be to be able to predict where the prices of investments are going, but in advance. Now, this is something famed investors like Warren Buffett, Ray Dalio, and Jack Bogle have said is not possible. Well, today is a special video as we check back in with Raoul Pal, one of the top thought leaders in crypto, as he says he's found a way to predict prices 6 to 18 months in advance. Now, with this being a very big claim, we'll take a look at how this is done and we'll see if in fact he's now able to do what no investor in history has been able to do. As always, if you do enjoy anything in the video, then drop a like, always appreciated. Okay, first up, Raoul reveals the secret, the one metric that can predict prices 18 months in advance, and it all comes down to one word.
Liquidity. And I think I'm able to forecast liquidity out for about 18 months, which may mean, and we'll have to wait and see, that means I can forecast asset prices going at 18 months. It's a kind of ludicrous idea to think that I could do that. This is the chart of the Fed balance sheet against the NASDAQ. You're all aware of this. This is my thesis that debasement of currency is driving the denominator lower. So every time the Fed print, the stock market goes up in kind of nominal terms. So that chart shows you the relationship. Now, it's not perfect, but I think the Fed balance sheet grows. And I put some of my target on here that it goes out to potentially $12 trillion, which might give a NASDAQ target of about 25,000, which is ludicrous over the next 18 months or so. Don't fixate on the target, fixate on the chart. But the second chart is the more important chart. This is actually global liquidity. And now look at that fit. That fit is staggering. That fit is so good, you can't argue that there is not a very, very close ongoing relationship. And anybody who says, well, correlation is not causation, listen, you're missing the whole point. The GMI Global Liquidity Index is a combination of the G5 central bank balance sheets plus money supply and other measures. And it's staggeringly good. So therefore, if this is the key driver of asset prices, then all we need to know is what's happening to liquidity.
And so the magic bullet of being able to predict where prices are going in advance is liquidity. And more specifically, the liquidity of the G5 bank balance sheets and money supply. Now, as this could be the breakthrough of the century, let's just take a quick look at those charts again. Starting with the first chart, which was the Fed's balance sheet and the NASDAQ. So this is the NASDAQ in blue, Fed balance sheet in white. And for me, this is all about correlation versus causation. And the famous saying, correlation doesn't equal causation. And what that basically means is that two things can correlate, meaning that they move together, but it doesn't mean that one causes the other one to move. And what Raoul Pal is saying is that liquidity, so the Fed's balance sheet, is in fact causing the move in asset prices, and that it doesn't just correlate. So let's just take a look. So for it to be a cause, you would want to see as the balance sheet is increasing, asset prices are increasing. And you could say the increasing liquidity is causing the move in asset prices, like it's doing here. This could be cause and effect. But then we get to here and we can see asset prices had a sharp decline, but the balance sheet was going sideways. So a question mark here. Then the markets began to take off here and the balance sheet was actually still going sideways. So in this instance, the asset prices are moving before the Fed. So you can't say that the expansion of the balance sheet is causing asset prices to move because the prices are moving before the balance sheet. Now, it then goes back in tandem, so they're both going up, which is fine, but then asset prices began moving sideways as the balance sheet was expanding. So again, it's a breakdown again here. Now, let's look here. So we can see a massive run in asset prices, yet the balance sheet was going down. So again, it's not correlating here. You can't say that increasing the balance sheet was causing the run. I can point out more. So there are times when they move together. So this is fine. Sometimes it does. But here we can see a massive run in asset prices, yet the balance sheet was going sideways and going down. So it's not even correlating here. So for me, I cannot see the causal relationship. But then he mentioned this chart, the GMI Total Liquidity Index. And this is mainly the G5 central bank's balance sheet and money supply. And he was saying that this is almost an exact fit. And anyone who thinks that correlation doesn't mean causation doesn't get it. So yeah, it's a closer fit. You can see that it correlates, but is liquidity causing the move of asset prices? Well, again, here we can see asset prices going up, but the liquidity index going down. You want to see them both moving together. So you could say that liquidity is causing the run here. So it is working here. Then liquidity index going up, but asset prices coming down. So it's not working here. Here it is working. You can say that liquidity is driving asset prices. Here's another instance where it isn't working. NASDAQ going up, but liquidity going down. And the best example is what happened in COVID. So the markets had gone on a massive tear, and then the market had a massive drop, and then the Fed reacted by printing lots of money, which certainly caused this massive run in asset prices. But Jerome Powell keeps saying that he looks at market data and then reacts. So another great example where asset prices crashed first and then the Fed reacted. So from what I can see, the model doesn't work. The markets can go up even though liquidity is going down, and the markets can go up even though liquidity is going up. So if it sometimes works and sometimes doesn't, it's not something I can bet my life on. Okay, next up, building on being able to predict what comes next, Raoul has stated that the bottom is in for crypto and that the stock market will be back to new highs by the end of the year. However, what about this impending recession? Surely this could cause the next downturn, right? What say the magic chart?
So you can see global liquidity came sharply lower. That brought all financial markets down. The NASDAQ, being highly correlated and a leverage play, came down more, and crypto, which is even more a leverage play on liquidity. But as that turned, so did markets turn. And this is where people are scratching their heads. I don't believe it. The market should be going lower. Can't you see there's a recession coming? Oh my God, can't you see that earnings are coming lower? Yes, yes, yes. The market knows it all in advance. The markets are forward looking. And there is this uptick in liquidity was actually forecast by our GMI indicator back in March of last year, showing that we would start bottoming and coming up from this level. The economy will follow suit. We're probably in a recession now, and then we'll have the kind of final stages of the bottom of the cycle, and then it claws its way back up again and doesn't become positive, let's say, till the end of the year, where GDP growth is positive again. But we'll have unemployment staying very sticky and prices coming lower. But liquidity is picking up, markets picking up. And if liquidity picks up further, whether the banking situation changes, the regional banks are still on their knees. So I still think the news flow gets worse and the Federal Reserve end up doing something. If not, the economy is going to get worse. The longer they keep rates up, the more probability is they have to cut rates rapidly later. The market picks this up. And so liquidity is driving everything.
According to Raoul Pal, he may have just stumbled across the holy grail of investing, a way to predict prices 18 months in advance. It's something that the biggest investors in history have all said isn't possible, but his secret is his GMI liquidity index, which is mainly the G5 central bank balance sheets and money supply. Now, for me, this all comes down to correlation versus causation, and I do see that they correlate, as in they move together, but I didn't see that the money printing causes the rise and fall of assets. There are times when the stock market crashes and then the money printer goes on, and vice versa. And Jerome Powell also keeps saying that he reacts to market data, which we can see in the charts. And lastly, just to say, I am a fan of Raoul and I do think he's done some great work, but on this specific piece, sorry, I didn't see it. So there you are, guys. Hope you enjoyed. Now tell me, what do you guys think? Have I missed something glaringly obvious, or can we all now predict the prices of assets before they happen? Let me know what you think below. And for now, just to say, if you did enjoy anything in the video, drop a like, and a big thank you to everyone who does, and I'll see you in the next video. Bye for now.